Hello students, today is class number 36 for on CMA and financial management. Today we are going to discuss about leverage analysis and EBIT EPS indifference point. Okay, so how the problems will come. I have chosen some problem from the study material. So how to use the leverage concept to find various things associated with the P&L, and how to use the EBIT EPS indifference point to identify the optimum financial plan for the company. I have chosen various problem that has a history of occurrence on your question paper. So let's discuss this for today, and let me go inside today's class. Yes. So what is leverage? So leverage, one second. Yeah. So the leverage is means of sensitiveness of one financial variable to change in another. Okay. So leverage is nothing but you are taking two financial variable or a financial term, and you are comparing it and how sensitive one is with respect to the other, and that we call it as leverage. The measure of the sensitiveness is expressed as a ratio, and we call it as degree of leverage. Okay, so there are three leverage, which is operating leverage, financial leverage, and combined leverage. What is operating leverage? So we call it as DOL, which means degree of operating leverage. So what is degree of operating leverage? So we have the P&L like this: sales minus variable cost is going to give you contribution. Contribution minus fixed cost is going to give you earning before interest and taxation. And next, if you reduce the interest paid on the debt fund, then we will get earning before taxes or earning after interest. Okay, so this is the normal P&L, and from this P&L, if you select the contribution divided by EBIT, so contribution, and after reducing the fixed cost, you will get the EBIT. The contribution minus EBIT, so I mean the contribution divided by EBIT is the degree of operating leverage. So fixed cost is lying in between. That's why I have highlighted it in yellow. So degree of operating leverage is the ratio of contribution divided by earning before interest and taxation. So that is, so fixed cost is nothing but the cost of your operation, the fixed portion, fixed expenses for your operations, and that's why it is called operating leverage. And now if you see financial leverage, it is nothing but earning before interest and taxation minus interest will give you earning after taxes. Okay, so now this interest as the portion, I have highlighted in yellow, the one above that and one below that, and that is going to give you the degree of financial leverage, which is EBIT divided by EBT. That is going to give you the degree of financial leverage. So what is combined leverage? Combined leverage is contribution divided by earning before taxes. This can be obtained by multiplying the degree of operating leverage and degree of financial leverage. So which means degree of operating, no, DOL multiplied by DFL is contribution divided by EBIT multiplied by EBIT divided by EBIT. So EBIT will cancel each other and contribution divided by EBT will come, and that is nothing but degree of combined leverage. So degree of combined leverage is the product of degree of operating leverage and degree of financial leverage. And this is about leverage. And for all this leverage, there is one more formula which we will see in our example problem. So please watch the video. There is an alternate formula for calculating this that we will see in the upcoming example problems. Now going to the next concept, what is this EBIT EPS indifference point? Okay, so many companies will analyze which mode we can choose for financing the capital expenditure or some investments the companies has planned. So any company will invest, and then they do the manufacturing or providing the service, and then they will get the returns in the term of profit, And going forward, the companies will keep on have some capital expenditure, capital projects and other projects, and they will invest money, and all these new projects will start earning revenue and profit at the later point of time, after the project tenure or after the kickoff of the project. They will start earning the revenue. So for this investment, the company has to finance this investment. So you as a finance manager has to select which mode is better for financing. So which mode is better on comparing the various modes, which factor you will compare on the various modes. It is most important factor is EBIT and EPS. Okay, the if for example there are two financial plans as shown here, plan 1 and plan 2. In this both plan is having the same EBIT and EPS point. So EPS in the y-axis and EBIT is in the x-axis, and these two lines are meeting. This meeting point is nothing but the indifference point. So what is indifference point? The both the plan 1. So this line is the plan 1 and this line is the plan 2, and both the plan is having the same EBIT and same EPS at this particular point, and that point of EBIT is called as the indifference point. Okay, because both the plans is good from the finance. If you are the finance head, from your point of view, both the plans are equally good. We can go for any plan. Okay, and you can say that to the corporate, and corporate will go for the loan or equity financing or whatever it is, they will go for it. Okay, so that is called EBIT EPS indifference point. So one more thing, what so the one point is when EBIT is at indifference point, both the plan is equally good. So EBIT equal to indifference point, any alternative can be chosen. If you have two financial plans and both the plan is having is at the indifference, which means EBIT is equal to EBIT, EPS is equal to EPS for both the plan, then you can choose any plan. Okay, that is okay, you can choose any alternative financial option. But if you are having a EBIT below the indifference point, so indifference point is at this level and your EBIT is lesser than the indifference EBIT point. Okay, lesser than the EBIT point. So what does this say? Your EBIT is lesser than the indifference. So EBIT, and after EBIT you have to pay your interest expenditure and tax expenditure. So interest expenditure is very important. Okay, so here you will, okay, so here the higher debt burden. For example, there are two financial plans in front of you. A particular financial plan asks you to go for higher debt, and second plan is going to ask you go for lower debt. Then you chose the lower debt because higher debt will have higher interest burden. Already your EBIT is lesser than the indifference point, so don't go for higher debt burden financial plan. You go for the other plan. Okay, so this is what, okay, so this is what is the choice we have to make when EBIT is lesser than the indifference point. When EBIT is more than the indifference point, this is the case. In that case, you can go for higher debt option also, because you have sufficient EBIT to pay for your interest expenditure. So you can go for higher debt burden also. You have still have cushion for accommodating more interest burden in your P&L. So you can go for higher debt burden also. So that is higher debt burden is nothing but how this is related to the leverage. Okay, you can go for higher degree of financial leverage. So higher degree of financial leverage means higher debt burden. Okay, you can go for high DFL option also. Okay, that is what is the, this matrix is giving you the reasoning. Okay, next there is one more crux that we have to break. Low financial leverage means the company is having low interest burden, and high operating leverage means high fixed cost burden, because operating leverage is contribution and EBIT, and in between that we are Ultimate, the concept is managing the fixed cost. And when it comes to financial leverage, the two factors are EBIT divided by EBT. So interest is the main factor of concern. So low financial leverage should be coupled with high operating leverage. High operating leverage, the company is already having high fixed cost burden. So its EBIT will be lower. So the company should not have too much of interest burden. So at that point of time, when high operating leverage is there, you have to couple that with low financial leverage. Same way, when high financial leverage is there, you can couple it with low operating leverage. By this way, we can find a right financial plan to finance our investments for the growth of our company. Let me go to the example problem. Okay, so this is a very simple problem. Okay, the Crompton Limited is a profit-making company, paid up capital of 100 lakhs. So 100 lakhs is the equity share capital consisting of 10 lakh ordinary shares of 10 each. So 10 lakh shares multiplied by 10 is equal to 100 lakhs. That is the paid up capital. Currently the company is earning a pre-tax profit of 60 lakhs. The company's shares are listed and quoted in the price range of 50 to 80. That is the market price of the share. Okay. The management want to diversify the production, approved a project which will cost 50 lakhs. So they have a project and for that they need 50 lakhs money, and which is expected to yield a pre-tax income of 40 lakhs per annum. Already the company is earning 60 lakhs. Now this new project, if you invest, and you will get a benefit of 40 lakhs more per annum. To raise this additional capital, what is additional capital? 50 lakhs is required for this project. Following options are under consideration. To issue equity share for the entire additional amount, it is expected that the new shares face value is 10 can be sold at a premium of 15, premium of 15. So face value is 10, sold at a premium of 15. So 10 plus 15, the share is 25 rupees. So 10 plus 15, 25 rupees the investors will be paying for you for every share. So that is the first financing option. The second is 16% non-convertible debentures. So debentures is also treated at par with the debt only, because it will also have a fixed coupon rate or fixed interest cost. Okay, of 100 each for the entire amount. 100 each. So one unit is 100 debentures you are issuing. So by issue of debenture, you are getting the money from the investor. The third option is equity for 25 lakhs, face value of 10, and debentures 16% NCD, non-convertible debentures, for the balance amount. The company can issue the shares at a premium of 40. So which means 10 rupee face value plus premium of 40. 10 plus 40 is equal to 50 rupees. 50 rupees the company will get for each share from the investor. Okay, so let's first do the small math, how much share will be there in each option. So option number one, already the company is having 10 lakh shares. So there is 10 lakh is the existing number of shares. In all the three options, or all the three options, we are considering three financial plans. So 10 lakh is the existing share. In the first option, how many shares you will issue? 10 rupees is the face value, you are issuing at premium. So 10 plus 15 is equal to 25 rupees per share. How much money you need? 50 lakhs. So 50 lakhs divided by 25 per share is going to be 2 lakh share. Okay, so 2 lakh share you will issue to finance this project of 50 lakhs investment. Okay, so 2 lakh plus 10 lakh, the total share will be for the plan option 1. The plan is the total number of share is 12 lakh. And second is the debt. So we are issuing only NCDs, which is non-convertible debentures. So we are not issuing any equity shares. The equity shares is 10 lakhs only. For the third option, we are going to issue equity shares for 25 lakhs. Face value is 10 at premium of 40. 10 plus 40, 50 rupees we will get for each share. So how much share we have to sell for getting 25 lakhs? So 25 lakhs divided by 50 is going to be 50,000 shares we have to sell to get this money. So 10 lakh is the existing share plus 50,000. 10 lakh 50,000 is the total number of shares. Next, this is the equity financing number of shares. Okay, next is the debentures. So debentures only in the option 2 we are giving, the option 2 we are giving fully debentures of 100 each for 50 lakhs. So 50 lakhs 16% interest debentures, and in the option 3 for the 25 lakhs we are going for equity, and remaining 25 lakhs we are going for the debt. So 25 lakhs debenture is there. Okay, so we have completed with the two financial plans. So in the three options, how is the equity portion and how the debenture portion is going to be. And now what we are going to, we are going to put the P&L and see which is the best plan to go with. Okay, so currently the company is making 60 lakhs profit. Okay, and if this new project for after investing 50 lakhs comes up, our earnings will go up by 40 lakhs. That is also given in the question here. So it will go up by 40 lakhs. So 60 lakhs plus 40 lakhs, 1 crore will be the your before tax, before profit before interest and taxing. So 1 crore will be the in all the three cases. Next, is there any interest burden? Option 1, there is no interest burden because it is fully financed by equity shares. Option 2, yes, we are giving 16% debentures for 50 lakhs. So 50 lakhs into 16% is 8 lakhs will be the interest burden. Same way for the option 3, 16% debenture for 25 lakhs. So 25 lakhs multiplied by 16%, 4 lakhs will be the interest burden. Reduce the interest burden from EBIT and you can find the profit before taxes, and it is given in the question, company pays an income tax of 50%. So if you reduce the tax 50%, you can get the profit after taxes. So profit after tax is found. The profit after tax divided by total number of equity shares which we have already found will give you the earning per share. So in the three cases we have found the earning per share, and it looks like the option 2 is having the maximum earning per share. So we will be choosing the option 2. This is what is called debt financing. Debt financing will increase the earning to the shareholder. How? The same number of equity shares is there, but your profitability is going to increase because your project is coming up, and that is going to give you the new earning, and that project is funded by debt funding. So whenever the debt comes in, there will be a leverage effect and your earning per share will go up. This is the concept of leverage. Okay, so here you can see when debt fund is there, that is giving you the maximum earning per share, because the other two cases your number of shares is increasing. Okay, profit after tax divided by number of shares is the EPS. So as your number of shares is increasing, your EPS is going down in option 1 and option 3. But in option 2, it is purely funded by debt and optimal debt. Okay, over debt burden is injurious to the P&L. But this is optimal debt. Company is in less than optimum, so it is more judicially utilize the debt fund, and now it can use more debt. It can accommodate more interest burden on the P&L. Okay, and that's why the EPS is going up, because even after accommodating this interest burden. Okay, so that is this problem, a very simple problem. You can give wordings like this, you can give more explanation, you can qualify your answers very well, you can get full marks for these kind of problem, and it's very easy. Let's go for the next problem. Okay, calculate the degree of operating leverage. So this is a very basic problem from the leverage. Degree of operating leverage, degree of financial leverage, and degree of combined leverage. So some details are given. Let's see what are the details given. Output of the firm. So let's assume that output as a sales also, output as a production quantity also. So fixed cost is given, variable cost per unit is given, interest is given, interest on the borrowed fund is given, selling price per unit is given. So selling price per unit multiplied by the output units will give you the sales. Okay, for all the three firms you can calculate the sales, minus you can calculate the variable cost per unit multiplied by the output per unit. You can get the total variable cost. Sales minus variable cost is going to give you the contribution, and we can find the total contribution, and total contribution minus the fixed cost is also given. You can find the EBIT. So EBIT is, you have the EBIT, you have the contribution divided by EBIT is going to be the degree of operating leverage. So degree of operating leverage can be calculated. Same way You have EBIT, and interest burden is also given in the question. So if you reduce the interest burden, you will get the EBT, or profit before tax, or earning before tax. So that can also, you can find it. EBIT divided by profit before tax is going to give you the degree of financial leverage. That also you can find the degree of financial leverage. Next, what is the combined leverage? Degree of operating leverage multiplied by degree of financial leverage, or you can say contribution divided by profit before taxes. And this is the formula. We can find the degree of combined leverage. Okay, so what is the crux? So we need to understand the concept of leverage with this problem. High operating leverage, which means high fixed cost scenario, combined with high financial leverage, which means high interest burden, is very bad for the company, or it is very risky for the company. Okay, and low operating leverage combined with low financial leverage is a very ideal situation. From here you can see operating leverage is lower in this case, and financial leverage is also lower for the firm M. So firm M is having the lowest degree of operating leverage and also the lowest degree of financial leverage. Hence, of course, the combined leverage is also going to be the lowest. So the firm M is less risky, low fixed cost, low interest. Consequently, this is low risky. Okay, so that is what is the choice that we are going to make. Interpret so we are just interpreting the results. So how the answers of the leverage is looking, and what is the inference that we can get from this, and how we can qualify our report to the management. That is what is the. Let's go to the next. Yes, so this problem is very important. Okay, we have to be very, this is very easy also. At the same time, it is very difficult to understand this. This is for the leverage concept. So there is no word called leverage that is mentioned in the question. The following information is available: PKJ and company, EBIT is given, profit before taxes is given. So EBIT is given, profit before taxes is given. The difference between these two is nothing but the interest. So we can find the interest. Fixed cost is given. So EBIT is given, fixed cost is given. EBIT plus fixed cost, we can also find the contribution. We can also find the contribution. So contribution can be found. Fixed cost is given here. EBIT is given in the question, and interest is not given. PBT is given 3.2 lakhs. So 11.2 lakhs minus 3.2 lakhs, 8 lakhs is the interest burden, and 11.2 lakhs plus fixed cost of 7 lakhs is going to be 18.2 lakhs, which is the contribution. So here what is asked? Calculate the percentage change in EPS if sales are expected to increase by 5%. So percentage increase in the EPS how much percentage it will go up when your sales is increased by a particular percentage. Okay, this type of question we have to apply the leverage concept. And till now we have not discussed about the alternate formula for calculating the leverage. So we have seen degree of operating leverage means contribution divided by EBIT. Degree of financial leverage means EBIT divided by EBT. So next, combined leverage is equal to degree of operating leverage multiplied by degree of financial leverage. Now there is one more new formula, which is degree of operating leverage can be said as percentage change in EBIT divided by percentage change in sales. Degree of operating leverage is nothing but percentage change in EBIT divided by percentage change in sales. Same way, degree of financial leverage is percentage change in EPS divided by percentage change in EBIT. And combined leverage is the product of operating leverage and financial leverage, and that's how the formula comes up. Yes, so that is the degree of operating leverage, degree of financial leverage, and degree of combined leverage. So that is the new formula, and we have to use for this kind of problem. And here you can find degree of operating leverage. We can find by contribution divided by EBIT, and we have already forecasted this P&L. And degree of operating leverage can be found, degree of financial leverage can be found, and degree of combined leverage can be found. And what is the formula that says degree of combined leverage is equal to percentage change in EPS divided by percentage change in sales. So percentage change in sales is given as 5%. So percentage change in EPS is equal to percentage change in sales multiplied by degree of combined leverage. So 5.69 times your percentage change in sales will give you 5% into 5.69. So this shows that for the little increase in the sales, there will be huge increase in the earning per share. Okay, and that we call it as the leverage concept. Sensitivity, as we discussed in the beginning of the class, is a sensitivity. Operating leverage is the sensitivity of EBIT, which is, you can say it as an operating profit also. Operating profit, sensitive. How sensitive is the operating profit or EBIT to change in sales? That is called operating leverage. And sensitivity of EPS to the change in EBT. EBIT. Okay, so how sensitive your earning per share for the changes happening in the operating profit. That is degree of financial leverage. And when you combine these two, it becomes how sensitive is your EPS for change in the sales, and that will give you the degree of combined leverage. You may get this in objective type question also. So please look at this formula and this sensitivity and this problem also very clearly. You will get objective also as well as some 3 marks problem also. So good. Let's go for the next problem. Okay, XYZ and company has 3 financial plans before it. So plan 1, plan 2, plan 3. There are 3 plans. Calculate the operating and financial leverage for the firm on the basis of following information, and also find out the highest and lowest value of combined leverage. Okay, highest combined leverage and lowest combined leverage. So production quantity is given, selling price per unit is given. So sales can be found. Variable cost per unit is given, so total variable cost can be found, and sales minus variable cost, we can find the contribution also. Next, the fixed cost is given, so contribution minus fixed cost, we can find the EBIT also. So EBIT is also there, contribution is also there. Contribution divided by EBIT, we can find the operating leverage also. So next, there is a fixed cost in 3 situations: situation A, B, and C. So situation A, situation B, situation C. Sales minus variable cost, contribution minus fixed cost is EBIT, and EBIT is there. So contribution divided by EBIT is going to give you the operating leverage. So degree of operating leverage is found from this table. Next, we have to find the financial leverage also. For making the financial leverage, we have to calculate EBIT minus interest. And if you see, the interest will be different in each plan. So the plan 1 is having 5,000 as debt finance, and 2,500 plan 2, and plan 3 is having 7,500. So EBIT we have already found, and interest of 12% that is given in the question, 12% interest. Plan 1 5,000, so 5,000 into 12% 600, and 2,500 into 12% interest on that is 300 for the plan 2, and 7,500 is the debt financing of plan 3 multiplied by 12% is 900. So interest you are reducing, and you can find the profit before taxes, and you have the EBIT divided by profit before tax. You can find the financial leverage. You can find the financial leverage. So we have 3 EBIT, and for this 3 EBIT, and you have 3 plans. So you can have situation A, what are the financial leverage, situation B, what is the 3 financial leverage, and situation 3, what is the 3 financial leverage. Now we are making the table and plotting all this plan 1, plan 2, plan 3, and situation A, B, and C. Highest combined leverage is going to be for this plan 3, situation 3, situation C, and the lowest leverage is going to be for this 1.47. That will be the lowest leverage. So this is what we are just making a table, and this is all concept we studied in our previous class itself. So high operating leverage should always be coupled with lower financial leverage. Lower financial leverage should be coupled with higher operating leverage. If your company is having any one as high, make the other thing as low. But what is the ideal situation? Lower operating leverage and lower financial leverage is a very ideal situation, because your EBIT will be maximum, your profit before tax will be maximum, your earning per share will be maximum. Let's go for the next problem. Okay, so let's go to the next problem, and this problem is little complicated, or the difficulty level is little high. For that, we should not leave the leverage is a very easy concept. We should not leave this. And all my classes, I am covering the main topics which has keep on repeated in the examination. And there is a high chance you can get exempted only by watching my video. I will be skipping some topics, but by watching my video, I'm sure you can get exempted, or I will be very happy if you get even above 50 marks. Let me go to this problem, because here we have to use our arithmetic skills, mathematical skills, equation skills to find the answers. Because the question has given only clues, and from this clues we have to find the values. Okay, the selected financial data for A, B, and C companies for the year ended March 2016 are as follows. So variable expenses as percentage of sales. Variable expenses as percentage of sales, which means if sales is there, and if we multiply by this percentage, we can find the variable cost, and the balance will be sales minus variable cost will be the contribution. So 100% minus 66.67 percentage for this A will be the contribution percentage. Okay, so 100 percentage minus variable cost percentage is going to give you the contribution percentage. Okay, so this is one concept. Next is the interest is given in all the three cases. Degree of operating leverage is given. Okay, so which means contribution divided by EBIT is given. Next, degree of financial leverage is given, which is nothing but EBIT divided by EBT. That is also given. Income tax rate is given. Prepare the income statement. Okay, you have to find all the income statement items. So what are all the income statement items? Sales less variable cost, you will get contribution minus fixed cost, you will get EBIT minus interest, you will get earning before taxes, minus taxes, you will get earning after taxes. So this 9 items is the P&L. So if these items are there, your P&L is ready. So how to find these items? Okay, now the formula, I am taking the degree of financial leverage. What is degree of financial leverage? EBIT divided by EBT. Okay, EBT can also be said as profit before taxes. Okay, so now we are going to use the clues that is given in the question to find all possible details to make a income statement or a P&L on our own. So EBIT divided by profit before taxes. Profit before taxes is EBIT minus interest, because interest is given in the question. So EBIT divided by EBIT minus interest. This can be said as, okay, and degree of financial leverage is given as 3:1 or nothing but 3. Okay, so EBIT divided by EBIT minus interest is going to be 3. Okay, so I'm just inversing it. So EBIT minus interest divided by EBIT is equal to 1 by 3. Now I'm breaking this fraction. So EBIT divided by EBIT is 1. So 1 minus interest divided by EBIT is going to be 1 by 3. Interest divided by EBIT is going to be 2 by 3, and EBIT is equal to 3 by 2 multiplied by interest. So same way, the degree of financial leverage is different for B and C. Apply the same concept. You can derive a formula for EBIT. And interest is already given in the question, 200, 300,000. Interest I have taken it here, and the derived formula you can apply for the interest value, and you can find the EBIT. Now very smart, we have found the EBIT. Let us apply the degree of operating leverage. So degree of operating leverage is contribution divided by EBIT. So contribution divided by EBIT, and contribution is nothing but EBIT plus fixed cost, because we already have the EBIT figures. So EBIT plus fixed cost, we have to find the fixed cost. So contribution is nothing but EBIT plus fixed cost. So EBIT plus fixed cost divided by EBIT. This can be said as 1 plus fixed cost divided by EBIT, and financial operating leverage is 5:1 is nothing but 5. So fixed cost divided by EBIT is equal to 4, and fixed cost is equal to 4 into EBIT. EBIT we have already found, and the same derivation you can apply for the B and C companies also, and you can find the EBIT fixed cost for all the three companies. So we have the EBIT, we have the fixed cost also. Okay. Now what is contribution? Contribution is nothing but EBIT plus fixed cost. Yes, we can find the contribution also, and we already have the variable cost percentage. 100 minus variable cost percentage will be contribution margin. So contribution margin can be found here. So this is 33% of sales. So which means sales figure we can find here. So contribution is 1500, which is nothing but 33.33% of sales. So sales is equal to 1500 divided by 33.33%. So contribution divided by contribution margin will give you the sales. Okay, the simple mathematics. So sales figure has been found. Sales is there, contribution is there. Sales minus contribution, you can find the variable cost. The variable cost is also found. So now your income statement is ready. You have the sales minus variable cost. You have the contribution minus fixed cost. You have the EBIT minus interest. You have earning before taxes, and you have the tax rate also. You can apply that, and you can find the earnings after taxes. So that is this problem, very simple one. And let's move for the last problem on the leverage topic. ABC Limited wants to raise 5 lakh as additional capital. It has two mutually exclusive alternative financial plans. Okay, so for this additional capital of 5 lakhs, you have two financing options. The current EBIT is 17 lakhs. The company is already earning 17 lakhs. So that is going to be 17 lakhs only. The relevant information is the present capital structure is 3 lakh equity shares of 10 each. So which means 30 lakh equity capital already you are having, and 20 lakh debt or through bond. So bond, debenture, debt, all this are interest bearing funds. Okay, so 10% bond is 20 lakh. Okay, so tax rate is given, current EBIT is given, current earning per share is also given, current market price of the share is given. I don't know how that will be useful. Plan 1, 20,000 equity shares at 25 per share. So that is the plan 1 through equity financing. Plan 2 is 12% debenture for 5 lakhs. So 5 lakhs is the amount that we need for our investment. So how to do that? Plan 1 equity route, plan 2 is debt debenture route. Okay, so what is the indifference level of EBIT? So indifference level means the two financing plan is going to have the same EPS, and that point we call it as, and that point at which what is the value of EBIT, that is called the indifference point. Identify the financial break-even levels. Okay, let's do that. Okay, so now we have to calculate the total capital in both the cases. That is going to be the same, but we have to see the proportion of how much is equity and how much is debt. Okay, so plan 1, we already have 3 lakh equity shares of 10 each, which is 30 lakh of equity, and in plan 1 we are going for 20,000 equity shares of 25 each. So 20,000 multiplied by 25 is going to give you the 5 lakh amount. That is the amount we need. So 5 lakh plus 30 lakh, 35 lakhs is the equity fund, and 20 lakh is the debt that is going to remain unchanged. In the case 2, 30 lakh of equity fund is going to remain unchanged, but we are going to finance through debt. So what is the debt? 5 lakh through 12% dividend. So 20 lakh plus 5 lakh is equal to 25 lakhs. In both the cases, the capital employed is 55 lakhs. So there is no doubt about it. Yes, so indifference point in both the cases, we are going to equate the EPS. So how we are going to equate the EPS? EPS is nothing but profit after tax divided by number of equity shares. So what is profit after tax is nothing but EBIT minus interest minus tax. So currently EBIT is 17 lakhs. After we get this 5 lakhs, our EBIT will go up. Okay, so we don't know what is the EBIT. So I am assuming EBIT as X, and I'm going to reduce the interest. So what is the interest current in the current scenario? 20 lakh bond, 10% interest you have to find. So 10% multiplied by 20 lakh is 2 lakh is the current interest level. In the new case, plan 1 we are not having, we are going to retain the same level of borrowed funds, but in plan 2 we are going to have 25 lakhs, 5 lakhs debenture financing 12%. So 5 lakh into 12% debenture, we are going to have 60% additional, 60,000 additional interest burden. So EBIT minus interest is going to be x minus 2 lakh in the first plan, and plan 2 x minus 2.6 lakhs. Now tax rate is given as 50% in the question. So multiplied by 50% on both the cases will give you the tax rate. And if you reduce the tax from the earning before taxes, you will get profit after tax. So profit after tax is found and divided by number of equity shares will give you the EPS. So what is the number of equity shares? So currently the company is having 3 lakh equity shares in both the cases, and in the new plan 2 we are not going to issue equity shares, but the plan 1 we are going to issue 20,000 equity shares. So additional 20,000 equity shares, the total equity shares will be 3 lakh 20,000 in the plan 1 and 3 lakh in the plan 2. So now we are going to divide profit after tax divided by number of equity shares to find the earning per share. Now I am equating on both the sides, and these zeros can be cancelled out. So it becomes 32 and 30. And now you are cross multiplying the both side of the equation, because I'm equating the both the sides because the EPS will be same for the plan 1 and plan 2, and that is the indifference point. Okay, so I'm equating this, and if I solve for x, it is going to be 11.6 lakh. So what is x? X is nothing but EBIT. So the level of EBIT at which the EPS of both the plans is same, that is called the indifference point. So at 11.6 lakhs, EPS of both the plans will be same. What is the EPS? You can just apply this on the EPS formula and you can check 1.5 will be the earning per share in both the cases, and that will be happening only when the EBIT is 11.6 lakh. So the indifference point of EBIT is 11.6 lakh. Next we have to find the financial break-even analysis. Financial break-even analysis is nothing but our profit is sufficient to take the interest burden. So financial, so which means the interest burden has to be taken. So what will be the financial break-even point? For the plan 1, the interest is 2 lakh. So if we take the 2 lakh, then we are in the no profit, no loss scenario. So 2 lakh will be the financial break-even point for the plan 1. In the plan 2, we are going for additional debt of 5 lakh rupees. So the total interest burden will be 2.6 lakh. So we have to take this 2.6 lakh to come to the no loss, no profit scenario. So the break-even point will be 2.6 lakh for the plan 2. Okay. So students, I have picked up most of the problem of leverage. Please practice well. All the very best. Meet you with the next class very soon. Thank you.